Hey, what's up, my friend? In today's video, you'll discover how to identify false breakouts and profit from trap traders. Here's what you'll learn, right? Number one, what is a breakout? We'll talk about what's a breakout, the two types of breakouts that you must know. Number two, what entices traders to buy breakouts? This is important because if you want to profit, right, from trap traders, if you want to profit from false breakout, you have to understand, right, what makes this type of breakout traders want to buy. What gets them excited? What gets them, clicking the buy or sell button? What is it, right? So we're going to talk about what entices traders to buy breakout. Number three, when will breakout traders get trapped? When will breakout traders realize, I'm in the red, the market reversed against me, We're going to talk about that, right? When that happens, okay? And number four, how do you profit from trap traders? So all this and more in today's video. But first, right, if you're watching this video for the first time, hit the thumbs up button and subscribe to my YouTube channel. The link is below, the button is below. Click subscribe. And this way, whenever I publish a new video, you'll always be updated. Sounds good? Let's get started. Number one, what is a breakout? So when we talk about breakouts, generally there are two types of breakout. Okay, a breakout, right, it occurs when the price exceeds a key level. That's kind of like the general definition. But in essence, right, there's really two ways, right, a market can break out. It can break out of a range. Okay, so for example, this one is the range. Market breaks out of resistance, breaks out of a range. Or the market can break out of a swing high or swing low. So for example, let's say market is already in an uptrend. Market can break above, right, this swing high, right, this swing high. So this is what we call a break of a swing high. Okay, so there are two ways a market can break out generally. Number two, what entices traders to trade breakout? This is important, right? Because if you want to identify false breakout, if you want to, profit from this type of, false breakout, you have to understand what makes traders buy a breakout. And traders, right, I'm sure you can agree with me, right, that you would like to buy breakout when the market is moving fast, when the candles is big, it's bullish, when there's strong momentum, when the chart screams, buy me, buy me, buy me. That's when you will probably buy a breakout. Okay, this is like psychological, right? When you see huge bullish candles, when you see the price, right, breaking new highs every single day, deep inside your heart, there's this voice saying, buy me, buy me, buy me. By the way, it's buy me, right? So let me just give you an example of what I mean by that. So if you look at this chart over here, okay, look at this strong, big bullish move. Many traders will look at this and say, oh, there's a breakout of this highs. Time to go long, time to buy. Look at the huge bullish momentum, right? Look at the huge bullish momentum. Look at the size of the candle, right? This breakout is strong, right? It's going to the moon, right? That's the thought process, right, that many traders will have. And that will entice many traders to jump the gun and buy the breakout. So you can see another one over here. At this point, you can imagine, right, before this became a shooting star, this candle was actually very bullish. It was actually looking something like this, right, previously. Nice green candle breaking out of the highs, breaking out of resistance. And traders will look at, oh man, look at this move, right? The breakout is real. Look at the range of the candles. Look at the strong momentum. So now you get my point, right? This is what entices breakout traders to trade breakouts. This is important, right? Because if you want to profit from this group of traders who get trapped, the breakout traders, you have to be aware of this, of what gets them excited, okay? And the reason why, traders trade breakout in this manner is because of the fear of missing out. They don't want to miss the move, right? They don't want to, to see the market take off without them and make them feel like a fool. So this fear of missing out, right, will cause traders to buy breakouts when the market is moving fast. Number three, when will breakout traders get trapped? This is the question, right? When will breakout traders get trapped? So clearly you know that they buy when the market is moving fast, when the range of the candles is large, when it breaks above resistance, for example. And they think that, oh man, the market is going to the moon, right? And they go long. And the next candle, the market does a 180-degree reversal and closes down below resistance. And they're like, what the beep? What's up with that, right? I thought the market is going to the moon, right? Why did the price reverse? Okay, that's where traders, they get trapped. When you buy a breakout, when you think, oh man, I'm gonna just make a quick gain, right, on this market, and I'm out of the trade. I won't be greedy. When you do that, the market does a sudden reversal. You couldn't even capture any quick gains, right? Before you know it, you're in the red. That's where you know that breakout traders, they are trapped. Okay, so it's usually in the form of a strong reversal pattern in the opposite direction. So you can imagine that if the price, makes, strong bullish momentum, breaking out new highs every single day, and on the reversal day, it's a bearish candle, a strong reversal lower. Okay, let me give you an example. Look at this. We have a nice strong momentum coming into this resistance. And you can imagine, right, this candle, before it became a bearish engulfing pattern, at one point, it was actually a bullish candle. The price was trading near this highs over here. So you can imagine that that candle was actually very bullish, breaking out of resistance. And traders would think, oh man, this reversal is for real, right? The market is going to reverse this entire downtrend. Time to buy. And they go long. And when do they get trapped? When the price makes a sudden reversal towards the downside. So you can see that this is a sudden reversal towards the downside, right? Closing near the lows, even breaking below the lows of the previous day. At this point, traders who buy the highs of here, who buy the breakout of resistance, they are now trapped. They are in the red. They're suffering. They are in pain. Okay, so this is what I mean by identifying, when breakouts trader get trapped. Another example, let me share with you. This one here. Okay, so if you look at this over here, again, market is in a downtrend, okay? Then notice that there is this strong bearish momentum towards the downside. And traders will look like, oh man, the price is in a downtrend. Time to sell, right? And notice this strong bearish candle lower, and they tell themselves, right, if the price breaks below the swing low, I am going short. And what happens, right? The market, at one point in time, it did trade near this lows over here. So you can imagine that this is actually a red candle, a bearish red candle, and within the day it reverses and closes up near this highs. So you can imagine if a trader were to short this swing low, if they were to short the breakdown, now they are trapped, right? The market makes such a strong rally, reversing, right, towards the upside. Okay, so I will talk about this later on, right? Even though this is a false breakout, but it's a false breakout that I don't want to trade. I'll explain why later on. Okay, and just to share with you one more example. Okay, so this is kind of similar to the one that you saw earlier on the pound dollar. Again, look at this. Very nice, strong, bullish move. At one point in time, this candle is actually a bullish candle, right? It's breaking out of resistance. And then what happened? Within the day, it reversed and closes near the lows. Now, traders who buy the breakout, they are trapped. Okay, so I'm going to talk about this, right? Specific how you can actually trade this false breakout coming up soon. So now you know, right, when breakout traders, they get trapped. So moving on. By the way, right, if you're enjoying this video so far, hit the thumbs up button. If you're not enjoying this video, hit the subscribe button so I can convince you, right, in future, right, that my content is good, right? So do it right now. So how do you actually profit from trap traders? So now you have learned a few things, right? Number one, you want to look for a strong momentum move into a key level because you know, right, that the bigger the momentum, the bigger the range of the candles, that's where it's going to entice more breakout traders to buy the breakout. That's where it gets them excited. Okay, first thing. Second thing, right? Wait for a strong price reversal and enter on the next candle open. So you want to see the candle. Let's say we are looking to short. You want to see a strong, big bullish move coming into resistance, a key level. And then, right, suddenly, out of the blue, the market makes a 180-degree reversal and closes near the lows, right? The reversal candle, usually the range, right, is pretty large as well. That's why you want to look for a strong price reversal against the strong momentum. Number three, right, you want to set your stops away from market structure. And number four, again, from a swing trading standpoint, you want to take profit at the nearest swing high or low. So I'll share with you a few examples, right, so you know how you can actually profit from trap traders. So first thing first, okay, let's talk about, since we are at Aussie yen, right, why not we just continue with this? So again, right, notice that strong momentum move coming to this area of resistance. Okay, we are not looking to short on a bullish candle where we want to let the price tell us that, hey, the sellers have come in and take control, and that's where we enter the trade. So at this point, we have a strong bearish reversal pattern towards the downside. So if you're familiar with candlestick patterns like, shooting star, engulfing pattern, this is the type of patterns that you want to look for. The larger it is, right, the stronger the price rejection, the better. So at this point, you have a sudden reversal, and where you want to enter the trade, right, is on the next candle open. So this is where the candle open over here, right, open at this price. And if you recall, right, I mentioned that you want to set your stop loss, right, a distance away from this highs, right? You don't want to just set it smack above here, because what the market can do is it forms somewhat of a double top, right? Like it goes down, spike up higher, double top, then comes down lower. So if you set your stop loss just above this highs, it's asking for trouble, right? It's asking to get stopped out even before the market can move in your favor. So I'm going to share with you a technique on what you can do about it, right? What you want to do is get an indicator out like the average true range. I typically use a 20 period, and I use the SMA. So it's really up to you, what settings you want to use. Okay, at this point, the ATR is about 50 pips, right? If you look at the value, it's about 50 pips. So what you want to do is find out what's this value over here. Let's say the value it's $76.30. You plus 50 pips, right? This one. So you get stop loss of $76.80. Okay, 76.80. Okay, so that's your stop loss, 76.80. So which is pretty much one ATR above this highs. Okay, so that's what I mean by setting your stop loss above market structure. And finally, right, you want to exit your trade before opposing pressure comes in. So that's where I mentioned that you want to exit your trade at, swing high and swing low. Okay, so this is just very basic trade management. You can get a little bit more complex and fancy later on, but I just want to bring to you the general idea first, right, before we, in future videos where we can talk about more complex stuff. So the swing low clearly is at this point over here. Okay, and you don't want to be setting your target, right, smack at these lows. Why is that? Because you have to understand that swing high, swing low, support, resistance, they are areas on your chart. They are not lines on your chart. This means, right, if that support is an area, the price might come near support and then reverse from it. The price might exceed support and then reverse from it. So it becomes an area. So there is a possibility where the price comes near support but does not touch the exact line and then reverse from it. And you don't want that to happen where the price, it's so near your TP, it's so near your take profit level, and then it reverse against you because you were too greedy hunting for the next 2 or 3 additional pips. You don't want that to happen, right? Give the market, some breathing room, right, for you to TP. Okay, so usually I set it a distance, I would say, at a conservative level at support, so somewhere about here. Okay, somewhere about here you can set your TP level. Okay, and in this case, right, the market did hover around, right, mess with your emotions, right, thinking you're gonna get stopped out before it finally, reaches the TP level. Okay, so this is Aussie yen, right, one example of a false breakout. I want to talk about the dollar yen as well, right? So that was something that I think I mentioned earlier why I am not looking to trade this. If you look at this, right, dollar yen, this is a false breakout over here, right? Notice that the price, it trigger below this lows and it closes near these highs. But I'm not looking to buy this false breakout. Why is that? Right, because this relates, right, to the earlier point that I was trying to make, where I said that, you're going to take profit at the nearest swing high or low. So if you look at this, right, the nearest swing high is actually at this point over here. So if you were to buy at this point, you can see that your potential reward is just from here to here. There's really not much meat left in the move. And if you're going to set your stop loss 1 ATR below this low, let's say somewhere here, you can see that your distance of your stop loss is this. Right, let's call this SL. That is your distance. And your reward is just here. From a risk to reward standpoint, it's not very attractive if you ask me. So this is why, even though it's a false break setup, but it's a setup that I don't want to trade. So whenever you trade a false break setup, you want to assess, right, how much am I risking? All right, your potential risk, and how much is the potential profit where the price could move right before it hits its first target, or how much the price could move right before it encounters opposing pressure. So most traders, they generally look for 1-to-1, but for me, I get a 1 to 0.8, right? I'm perfectly fine with it. Okay, so this is another $1 yen, all right? It would have been a winning trade, but it's a trade that I clearly wouldn't have taken. Okay, one more example, pound dollar. Okay, so this was the one that we spoke about earlier. So this is very similar to the Aussie yen ones. You can see that again. I'm just going to be fast with this. Strong bullish move into this area of resistance. At one point in time, this candle is very bullish. Traders will think, oh man, this breakout is real, right? Price was near the highs. And then within the day, it closes near the lows. This traders who buy the breakout, they are trapped, right? So you can actually go short. Potential targets is at this level. This is where, buying pressure could potentially come in right at this area of a support or swing low. Okay, again, stops 1 ATR above the highs. So in this case, doesn't really matter whether it's a winning or losing trade. I think the concept that I'm trying to teach you is more important. And another one, right, to share with you, it's a losing trade, but again, it's a setup that is a valid setup, even though it's a losing trade. So this is a little bit different in terms of the false breakout. So in the earlier examples, you saw that the false breakout occurs within the same candle. But sometimes, right, the market takes time to play out. It could, consolidate a while at a level before it reverse. In this case, you can see that Euro Aussie at this area of support, right? Notice this strong down move lower, how big and bearish the candle is, right? How price, break below this swing low or support. Right? Traders will say, oh man, look at how bearish this market is, time to go short, and they go short. Then what happened interestingly is, next few candles, market consolidate. Okay, consolidate. And the fourth candle, it breaks and closes higher. So now this to me, right, it's a false breakout. This 4 candles, if you look at it as a context, as a 4 candles together, this tells you that market consolidate, undecided, and then the bulls step into control and close near the high. So this is a false breakout of this lows. Okay, so this is a setup, right, valid setup to go long. Again, stops right away from market structure. And you want to ask yourself, right, where might opposing pressure come in? And if you ask me, I'll say somewhere about here and even here. Okay, in this case, right, price clearly just, went against you. Probably get stopped out on this move and then it reversed and probably would have, hit your targets. But hey, that's trading, and I just want to, be honest and upfront about this. Okay, so hopefully these few examples over here, I give you a good example to, how to identify false breakout and profit from trap traders. So sometimes you profit from the trap traders, sometimes you get trapped and they profit from you, right? It happens, okay? So you have to kind of embrace this. So some quick bonus tips for you before we end, right? So number 1, you want to trade off obvious levels. I like to look at obvious levels that, sticks out in front of your face. Why is that? Simple, right? When you trade off obvious levels, right, it can be seen on a higher time frame, and on top of it, right, it will attract more order flow to it. In other words, it will attract more traders to it, right? More traders take notice of the level, they would be more attracted to it, and more orders will be around it. Maybe traders to buy breakout, maybe traders to trade the reversal. So when there's more orders around it, right, the volatility of the market, the impact of the move, right, is usually larger when there's more attraction to it, right? So you can expect a bigger move. Okay, so this is why you want to trade obvious levels. Number 2, right, you want to see big bold candles approaching a level. I think this is a concept that I've been hammering home throughout this whole video. You want to see a strong move into a level. That's what attracts traders to chase the market, to buy the breakout, because you have the fear of missing out. So when you trade false breakout, you want to see this big bold candles approaching a level. Number 3, you want to see a strong reversal pattern. Then I put bracket 1.5 ATR. So what this means, right, is that when the market makes a reversal, right, if you want to define, right, what is a strong reversal, you can make sure, right, that the reversal pattern, right, is at least 1.5 times ATR. So for example, again, right, you just do a quick one. Let's say, let's go to this one over here. Let's say this Aussie yen, right, it is a reversal candle, but you're not sure whether is this a strong reversal or just a normal one. So what you can do is, again, pull out the ATR indicator. Okay, I'm not going to change these settings, right? My default settings I use is 20 and SMA, but just not going to do it. So let's say the ATR is about 50 pips, right? Let me make my life easier. Let's say the current ATR value is 50 pips. So if you want to find out whether the reversal pattern, is it a strong one, you want to make sure it's at least 1.5 ATR. Okay, so if the ATR right now is 50 pips, right? So 1.5 ATR is 1.5 times 50, it's 75 pips. So what you want to do is find out, right, the range of this reversal pattern from the highs to the lows, right? Is it at least 75 pips? If it's at least 75 pips, right, then you can say that, hey, this is a pretty strong reversal pattern, right? So 1.5 ATR is like a kind of a guideline that you can use. Okay, and next one, the further away opposing pressure is, the better. So again, this brings back to the concept of, what is your potential risk to reward. So you saw earlier the dollar yen example. The opposing pressure is very near your entry. There's not much meat left in the move, right? So you don't want those type of trades. You want trades where the opposing pressure, right, is far away from your entry. This means that the market, right, the price has more leeway to move, right, before reaching your target. So this is why I said that the further away opposing pressure is, the better. Okay? So with that said, if you want to learn more, if you really enjoyed this video, you want to learn more about price action trading, false breakout, and stuff like that, go down to my website, tradingwithrayner.com. Link is above here, tradingwithrayner.com. And scroll down, there's this guide called the Ultimate Guide to Price Action Trading. We'll talk about more in-depth stuff, support resistance, candlestick patterns, and much more. So click this orange button and I'll send it to your email address for free. So with that said, I have come towards the end of this video. Enjoyed it? Give me a thumbs up, subscribe to my YouTube channel, button is below, and I will talk to you soon.